Capital One is buying Discover. This deal combines two of the largest credit card players in the US, and we'll talk about everything you need to know about. This includes why I think it might be one of the best investments for Capital One, and what it means for us as consumers. Big favor before we dive in is to give us a thumbs up to help with the algorithm, and if you are new and you want to maximize your points and your spends, then consider subscribing. Okay, let's go through all the details. Capital One announced that they were acquiring Discover in an all-stock deal valued at $35.3 billion. Discover shareholders will receive Capital One shares, pretty much 27% premium over Discover's closing price on Friday. At the end of all of this, Capital One shareholders will hold about 60% of the company, and Discover shareholders about 40%. This is an acquisition, but the companies are pretty sizable in their own right. Capital One has a $52 billion market share, Discover almost $28 billion. Also 54,000 and 20,000 employees, respectively. We'll get back to the employee point later in the video. The argument is that Capital One is making a big bet during a booming time in the credit card sector. A lot of consumers are moving from paying with cash to cards. I was actually a bit skeptical about this point because for a long time the talking point was that Gen Z didn't care about credit cards and they were very cash focused. Apparently 50% of Gen Z has credit cards and they have prime and above credit scores, which actually surpasses millennials when they were the same age. By itself seems pretty straightforward, but I think it is a distraction and there is more going on in the background. Discover isn't just an issuer of credit cards, they're also a network like Visa and MasterCard. Even though they are a lot smaller, they are a competitor. Depending on how Capital One wants to play this, it can be both an insurance policy and also a big bet. Capital One is the 9th largest bank in the US and a major credit card issuer. They use both Visa and MasterCard for most of their cards. They do plan to switch some of the cards over to Discover. I think for the travel cards like the Venture and the Venture X, they probably will keep it with Visa because of the acceptance rate, but for the other cards that are more domestic focused, like the Saver One, you might as well bring it over to Discover. Capital One also plans to maintain Discover's brand, cards, and network. All of this is assuming that regulators sign off. This brings up a great question whether it gets blocked. There's a ton of acquisitions that happen where the government comes in and vetoes it. One of the best examples of this is JetBlue's acquisition of Spirit. They made the bid, it was blocked, they tried to appeal it, and they might back out entirely. Competition is good and better for consumers. Therefore, by that logic, they should block this one as well, and that's it. Not really, because within airlines, it is a bit different. You have 4 mega airlines that cover most of the US and move 150 million passengers per year. A notch below this, you have Alaska, Spirit, and JetBlue, who move only about a third of the passengers. They also might be a bit more regional, and you can think of these as the low-cost, mid-sized airlines. Call me crazy, but it feels like there is a lot of overlap. This is JetBlue's route map and where they fly. This is Spirit, and if you overlay the two together, they kind of look pretty similar. You have a lot of the same dots, meaning they fly to the same airports, meaning that it hurts competition. In contrast, if you compare it to Southwest, it does feel dramatically different. So if the JetBlue and Spirit deal were to go through, then that's 2 of the 3 mid-sized airlines merging together, both of which covering similar grounds and arguably being low-cost carriers. So that's airlines, but I would argue that Capital One and Discover are dramatically different. With credit cards, you have a pretty big firm 5 with Chase, American Express, Citi, Capital One, and Bank of America. This is where the majority of the purchase volume is going through. Discover is number 6, about half the volume of Bank of America, and about almost 1/5 of Chase. The thing though is that these are not the target for the government. It's Visa and MasterCard. If you look at the networks, you have 2 big giants, one at 273 million and one at 363 million cards in circulation. In contrast, Discover is only down at about 1/6 of that, at about 60 million, and American Express even smaller, at 56 million. A lot of people in the government hate the fact that Visa and MasterCard have this level of power. So much so that they've already tried to pass things to address this duopoly that controls 80% of the US credit card market. We have talked about this in the last year and how it would probably be bad for consumers because the big box retailers are not going to pass the savings back to us. The long and short of it though is that most credit cards are going to need to have 2 networks. So for the Chase Sapphire Reserve, it's Visa and something else. It cannot be MasterCard. The second network requirement only applied to Visa and MasterCard, and there were a bunch of exceptions. For example, cards where the network itself is the card issuer, such as American Express and Discover, would not be required to add a secondary network. At the same time, American Express and Discover could serve as a second network on the other bank's cards. Main takeaway, the government hates Visa and MasterCard. They do seem to like Discover and American Express. I would argue that this deal increases Discover's power, maybe pushing the power level over 9,000. For this reason, I think there is a decent chance that the government lets this go through. We'll get into it, but I think Capital One bought themselves a pretty good insurance policy and potentially a big bet. Before we dive into what this means for the companies, this video is brought to you by Moomoo. They're currently offering up to 15 free stocks and 8.1% APY for 3 months. Moomoo is a registered broker-dealer and regulated by FINRA. They're also a member of SIPC, meaning that you're covered for up to $500K, including $250K for cash. Unlike a lot of other trading platforms, you don't have to pay for level 2 data or extended trading hours. These are things that come with the platform, meaning that you can trade with a 16-hour window between 4 a.m. and 8 p.m. Eastern Time. You're getting 5 free stocks for depositing $100 and 10 free stocks for depositing $1,000. Best case, try the platform and maybe you like it. Worst case, 15 free stocks. And you also lock in 8.1% APY uncapped on your uninvested cash. Even if you're just a yield seeker opening up accounts for interest, this is a pretty good rate. The current offer ends on February 29th, 2024. If you are interested, go to asksebi.com/moomoo or link down below in the description box to get 15 free stocks and 8.1% APY for the next 3 months. Okay, so what can this mean for Capital One? I think there's 5 potential key things. Number 1 is insurance. If the government does push a Credit Card Competition Act in some other form, then they can just move all their cards over to Discover. If Discover was a standalone company at that point, then they, along with American Express, would be in the power positions. If you have to add another network and there's 2 big other networks, you might as well own one of them. Number 2 is going to be upside. In the same vein, if that does happen, or even if it doesn't, they can grow that network and make more money. Capital One has a lot of optionality here, whether they want to build a Discover business, or maybe they just treat it as a deep out of the money leap option. If regulation does happen though, then this might be one of the best investments that they've ever made. Maybe not to the level of Google buying YouTube for $1.6 billion, but if this does hit, then they could easily pay back the acquisition multiple times over. Number 3 is negotiating power. Again, I don't think cards like the Venture X are going to move off Visa because they need that for acceptance, but now they are in that position where they can maybe push up their rates. For example, a merchant pays 2.5% to Visa for accepting a credit card. Of that 2.5%, there's obviously employees and fraud and other costs. But within that, there is an amount going back to the issuing bank like Chase and Capital One. Maybe before their take rate was 0.5% for managing that card and issuing it, and now they can push it up to 0.6%. If you own Discover, if you own a whole network, then that's leverage. Number 4 is employee overhead. Capital One has more than 50,000 employees, Discover has 20,000, and these are pretty gigantic numbers. I wouldn't be surprised if most of this was customer service, and I wonder if Capital One can kind of shift some of their demand over to Discover's team. Discover is known for their customer service, so I don't see them laying off those people, but yeah, there has to be some synergies. Number 5 is cross-selling. In the past few years, we have seen Capital One move more upstream to compete with the Chase Sapphire Reserve and the Amex Platinum. Is there a world where Discover takes the subprime side and the downstream side, and that way Capital One can focus on the upstream and premium clients? I think a complete separation is unlikely, but still, if you have 2 different sides, it means that you can focus on one of them and let the other company do the other side. Also, if eventually they can figure out how to make Discover into a feeder system into the premium Capital One cards, then that could be an easy win. Over on Discover's end, I think there are a few easy wins. Number 1, they can dramatically increase the number of cards on their network. If Capital One even moves 20% of the cards to Discover, that can be pretty sizable. In the US, I think Discover has done a pretty good job, but the moment you go abroad, it is a lot weaker. In the long term, having Capital One as a partner might change that. Going back to the YouTube example, they were a money-losing startup before, and they needed Google's scale. Obviously a bit different with Discover, but having additional scale helps. Number 2, they might get more negotiating power on the merchant end. The larger the Discover network grows, the more negotiating power they have with their merchants and the more money they can make. Number 3 would be Capital One's tech. So when I started YouTube to right now, Discover hasn't really changed anything. In that time, Capital One and American Express have launched a ton of features and done a lot of revamps. If anything, I feel like Capital One is one of the best at shipping products in terms of tech. Number 4 is travel perks. Discover pretty much got all their benefits, and I feel like if they do work with Capital One, then maybe there are some that they can add back. Number 5 is the transferability of Discover It miles. Even on Capital One's end, it should make sense for them because it means they can bulk buy more miles for people, and it should be cheaper. To be fair, a lot of this is up in the air, and maybe even 2 or 3 years out. One obvious question is who's winning and who's losing. I think I'm at the point where I wouldn't want to bet against Capital One. When the Chase Sapphire Reserve launched back in the day, I made fun of the venture because it felt pointless. It was pretty much a card that didn't have any upside and didn't make sense. Fast forward and they added transfer partners. Okay, transfer rates suck, They ended up improving them. Okay, Capital One doesn't have lounges like American Express. They add lounges. American Express has FHR. They add their own hotel collection. American Express has a waitlist for the Centurion Lounge. They add their own version. In a lot of ways, Capital One feels like a tech company in that they actually ship products and want to do cool stuff. With that said, I am bullish that Capital One can improve the Discover network and make it even a bigger company. In terms of losers, I would say MasterCard because they do rely on Capital One for a lot of the lower annual fee cards. If anything, I feel like the MasterCards are the ones that are most likely to go over to Discover. Again, if you want to sign up for Moomoo, we have a link down below, 15 free stocks and 8.1% APY. AskSebby.com/Moomoo or link down below. If you made it to this point, leave an orange circle emoji in the comments down below and I'll try to heart it and also respond. My question for you are, what are your thoughts on this? Do you think it's going to pass? Who do you think is winning and losing? And what would you expect? Let me know and everyone else know in the comments down below. Big favorite, thumbs up, consider subscribing, but otherwise, hope you liked it. See you next time.